Oh man, crypto. We've gotten a lot of requests from
Yeah.
crypto firms to have us work with them in some way, shape, or form. And I think crypto has a lot of different shades, right? You have the DeFi side, you have the real world asset side, you have sort of the staking side. I guess it's part of like DeFi as well. But it's just a hodgepodge of everything. And I think what's been interesting to watch is that a lot of these companies are trying to learn and speed run through financial markets and financial market history that has taken like several hundreds of thousands of years to create. They're kind of just doing it in 2 months, 3 months time, and they're seeing the blowback as well coming from that.
Hello and welcome to another Real Vision Essential interview. I'm the senior editor at Real Vision, Andreas Steno, and today we're going to talk about kind of a dark spot for me when it comes to financial markets. The asset class private debt has been growing materially over the past decade, and in that regards, it's a pleasure to be joined by the founder and CEO of the company Percent, Nelson Chu, for a discussion on that particular asset class. Welcome, Nelson. It's a big pleasure to have you here.
Yeah, thanks so much for having me.
Before we get started on the discussion on this growing asset class private debt, I want to allow you to sort of introduce yourself to the audience. Nelson, please give us a bit of an overview of your career so far and your journey with the company Percent that you founded.
Sure, absolutely. So I started my career in traditional finance, as I think most fintech founders probably had that experience in some way, shape, or form. I started out at Merrill Lynch in 2009, which was a very lovely year to be joining traditional finance. Lasted about 2 months before that became Bank of America. So, out of necessity, stayed at Bank of America. And then after that, I got the pull to go to the buy side. Everyone said the buy side was better. And so I took a job at the largest buy side shop on the street in BlackRock. And so I thought that would be a lot better. Ended up lasting just about a year there before I said, you know what, I am never doing finance ever again. And here we are I am running a capital markets fintech company. So, famous last words on that side.
Yeah, what made you decide to found the company Percent then?
Yeah, so I think it was almost like what happened after that. I left finance in about 2012, 2013-ish to really pursue my own thing. The New York tech scene was really starting to take off. And I thought, you know what, I'm going to try this out myself, see how it goes. And what ended up being my first startup was really a consulting company that helped other founders build from the ground up. And so we gave them product, marketing, branding, engineering expertise. And with that, they were able to really accelerate the growth of their companies. And so we had a really good couple case studies coming out of that. One of the companies was a company called BlockFi, which had done very well up until this point. And that was the one that really made me go, you know what, for the right idea, the right time, I should do things the old-fashioned venture-backed way. And I think out of almost like accident or necessity, I guess, a lot of the clients that I had on the consulting side were fintech companies because they saw my BlackRock background, they saw the Bank of America background, and they were like, yeah, you could definitely help me. You know how to do a P&L, you have some design skills, this really could work out well. So I've always been in and around fintech, and that's really how we saw the opportunity for Percent. What we are doing today is very different from what we were when we first started, but it's always with most startups, where you start isn't where you end, generally.
Yeah, true. Give us a brief overview of the company Percent. What do you actually do?
Sure. So if you go to our website, we kind of look like a lot of different alternative investment platforms that are out there. We offer private debt opportunities, which we can talk about in a little bit, that you can just invest in, diligence, and do all that good stuff. But behind the scenes is a really powerful infrastructure solution powering software for both borrowers who need debt capital, underwriters who are responsible for structuring these products, these investment products, and investors who are actually looking to invest. And so that's all happening behind the scenes that you really don't see from just our front-facing percent.com website. And so that allows them to manage their entire debt capital market needs in one place throughout their entire life cycle. You can find a transaction or a borrower, you can structure the transaction, you can market it, and you can do surveillance on it after it's done. These are all workflow tools that are really what makes the private debt market work that just never existed today because our benchmark is essentially Excel, phone calls, and emails.
True. I mean, let's talk a bit about private debt. I'm personally born and raised in public debt, so traded bonds, etc. Right? Let's introduce it a bit to our audience. This asset class, private debt. How would you define it?
Yeah, it's interesting. It actually powers so much of the global economy. You just don't really recognize it. And I think it really had its moment after the global financial crisis. So rewind back to '09 when I just graduated college. And they were essentially a time where the banks really took a step back from conventional lending to small businesses, lending to consumers. And really, a lot of that was down to the regulatory requirements around capital reserves they had to hold in order to make those type of loans. So by taking a step back, you had this huge gap in the market where other people had to fill, right? Clearly, businesses still needed loans. Consumers still needed loans. And so where was it going to come from? It was going to come from these non-bank lenders. And non-bank lenders are the ones who are essentially, in the name itself, not a bank. They don't have a balance sheet. And so they actually have to source a warehouse facility or credit facility from somewhere else to be able to finance the growth of their business. And so throughout, I would say, '09 till even very recently, private debt has just been absolutely booming because they've been filling the gap that the banks left behind. And VCs have been powering that as well. Now, when you see the likes of like buy now, pay later, when you see the likes of revenue advances or factoring receivables or things like that, that have driven a lot of VC interest, that is really what makes up private credit. So it powers so much of what goes on a day-to-day life. You just don't even realize it.
Yeah, that's absolutely true. If we look at this asset class size-wise, how big of an asset class is it compared to other asset classes?
So you're on the public debt side, so I can use that as a comp. Public debt markets are about $52 trillion, and there's about a $9.5 trillion credit default swap market underpinning that as well. Private debt is actually only 7 trillion. And so without anything of the efficiencies that public debt markets have, they've still been able to grow to about 7 trillion. So that's comprised of a lot of different types of sub-asset classes within private debt. Some of them could be what's called structured finance. And so that is almost like a securitization, essentially. There's public market securitizations, which I'm sure you were involved in, and there's private market securitizations as well. Then there's really just conventional lending to these businesses, like middle market lending, bank commercial lending. And then there's a very large US private placement market that essentially drives a lot of these kind of bigger ticket transactions as well. So those are kind of what makes up the 7 trillion in a nutshell.
So if we become very concrete, what kind of projects can you fund via the Percent platform, for example?
Yeah, we cover a lot of ground, actually. So we have small business lenders on our website. And so investors have the ability to get exposure to loans to small businesses, not just in the United States, but also in Latin America, in Europe, in Africa. We also have consumer loans. And so consumer loans range from earned wage advances to just general consumer loans, not in the United States. You have factoring of invoices, so being able to essentially take an invoice as collateral and be able to advance them a certain percentage of that. There's a whole subsector of private debt called litigation finance, where they're essentially providing financing for settlements and things like that, or at least to go through litigation, depending on where you are in the life cycle. There's equipment leasing, whether it's a crypto mining rig, which was really well and good maybe about 4 or 5 months ago, and not so much right now. But there's also just conventional machinery and equipment leasing on that side as well. So it is covering so many different sub-asset classes within the economy that everyone is probably semi-familiar with at the very least.
Yeah. Which of these pockets are growing the most, would you say?
So it's interesting. We've been around for 4 years, and we've seen a lot of shift and changing over time. And it almost is directly tied to sort of sentiment around the economy. So I can kind of rewind back a little bit to COVID times. When we were all stuck at home, e-commerce was all the rage, right? And so literally e-commerce financing and and mobile apps too, because everyone was on their phone. Mobile app financing just absolutely blew up. There was so much demand for it, and people couldn't even get enough money for just holding the inventory to be able to do these types of sales and for the merchants. As that evolved, or the market picked up steam again, we came back outside, COVID subsided, small business lending started to take off as well, right? Because businesses need to get back back in shape and back to normal and start operating again. And then now we're seeing a stage where, consumers, because of where things are at and sort of the situation with the market, they're a little bit tight, right? So they also need loans as well. So it is extremely cyclical. There are a lot of macro headwinds and tailwinds that drive interest and demand in the private debt space that makes for a very interesting and fascinating opportunity to watch, especially since we have such good visibility into the underlying performance of these borrowers.
Yeah. Who are the typical buyers of these products? I mean, when I look around the public debt markets, we obviously have big institutions buying a lot of the bonds, right? Would such institutions be involved in the private debt space as well?
Yeah, public debt is so much simpler. There's, market standards in place. You have ratings agencies that tell you whether it's investment grade or high yield. You have data standards in place because there's required reporting from the SEC and audited financials. And you kind of know who's there, right? You have public companies who need debt, investment banks who structure it, and these institutional investors, like you mentioned, who are investing in these products. On the private debt side, these small transactions could be as small as 50 grand, and the large transactions could be as large as 250 million. And so when there's such a wide spectrum, it's a very different and diverse set of audience as well. So on the investor side, you're going to see on the 50 grand side to even 1 million side, those are going to be your accredited investors. Those are going to be people who are high net worth individuals looking to diversify their portfolio, looking to find alternative areas of return, in which case, private debt has done very well in this market downturn. You have family offices and credit funds who are looking to get exposure and diversify their portfolio as well. And then you have institutional investors, which are multi-billion dollar, multi-strategy credit funds who have this is their asset class, right? This is what they focus on. And they put hundreds of millions of dollars to work per transaction to be able to make it all go. So it is a very diverse array of audiences here looking for this type of paper.
Let's dig a bit into the performance of the asset class this year. We all know that it's been a tough year, basically across almost every single asset out there. If we look at public debt, it's almost impossible to find a bond performing this year. What about private debt?
Yeah, it's actually done quite well, but it very much comes down to the structuring and also to the underlying performance of the assets themselves. And those two almost always go hand in hand. So I would say, for us in particular, we're recording this on July 6th, 2022, about halfway through the year. Our weighted average return is about 12% annualized. And so we're still tracking to about 6% in interest that we paid out blended over the course of the year, which is much better than probably the rest of the market at this point. So that's very comforting. I think the benefit for investors is that they have the opportunity to actually monitor the performance post-close. And so a big value prop for Percent is our ability to actually provide this type of surveillance reporting. So there are definitely private debt opportunities that have not gone well this year, without a doubt, not on our platform at the very least. And it really very much comes down to the structure and the assets themselves. But if you give investors as many tools as they need to be able to diligence it properly and then monitor it post-close, they can make the best educated decision for themselves. Just to be perfectly upfront, if something's offering 25, 30%, there's probably some risk associated with that you need to know walking into it, versus something that's offering 6 to 7% is probably priced in that level of risk as well. So investors need to be a little bit smarter about how they want to diversify. But in this environment where you're looking for yield and looking for spread above inflation, people may go further up the risk curve to be able to do that.
When I buy an investment graded bond, Nelson, it's pretty easy for me to market that bond every day because it's usually traded every day, or at least I get a price on the screen, right? How would you assess sort of the running return on private debt? Is it as easy as with public debt?
Definitely not as easy because the financials and the reporting is just not nearly as clear, right? But that's part of what we're trying to change. We're trying to essentially bring public market efficiencies into private debt markets. So all the things that you're used to, whether it's standardized deal structures with that almost like rating type mentality associated with it, the standardized reporting for investors to be able to compare, all those things are things that we're trying to bring to the table here. So just as an example, because crypto seems to be on the top of everyone's mind right now, given how far the market has fallen, we have a couple crypto lenders and just issuers on the platform ourselves. And we've been able to see their performance almost in real time, right? Pretty much every day. And so on the structuring side of things, we have something called over-collateralization requirements, right? Which means that a lender needs to be able to have a certain level of collateral on their balance sheet that's probably higher than what the actual assets are worth. And so what's been fascinating to watch, because we have this on a daily basis, is these crypto lenders, whenever Bitcoin crashes, you see them dip very close to that over-collateralization minimum that we set for them. And then they margin call their borrowers, and then you see the over-collateralization rise up again beyond the excess amounts that they need. And so when you look at these reporting, you can pretty much, not knowing the price of Bitcoin on February or April or June, you'll know when it crashed because you saw the over-collateralization dip to the minimum level, and then they margin called on the way up. This level of transparency is what is almost akin to public debt markets, right? Not exactly, but it's close enough or closer than it's ever been before, thanks to a lot of things that we're doing on our side.
Let's assume that I go to the Percent platform and actually invest in a private debt deal via the platform. How often would I be able to sort of look at my returns? Would I be able to look at them daily, weekly, monthly, whatever?
Yeah, I would say the returns generally pay out on a monthly basis, and we have different structures in place. But you'll be able to almost like get a sense for, if it's going to be X percent APY, unless there's a default on the underlying payment, then you should expect to get that interest that was promised as part of that transaction. But defaults obviously do happen. We provide investors with a lot of optionality on that side as well. Obviously, there's a lot of people who like to do direct deals, pick their own. They want to get exposure to Latin America, the US, Europe, and they want to diversify their own way. We also have the blended note, which is almost like a basket of different notes underneath. And so that has a variable APY, so that when you won't know exactly, how much interest is being accrued. But it is around 10% annualized, and you do get interest payments monthly, essentially. And it's based on how it's been deployed into these various transactions. So the optionality and the ability to track performance and the returns, we try and be as transparent as possible. But the ones that are variable, you just kind of can't predict until the month is done.
If we look at the relative pricing between public debt and private debt, take us a bit through your thinking on the spread between the two asset classes, which kind of nominal returns you can expect in the current environment, et cetera.
Sure. It's getting wider. I'll say that
Yeah.
for sure. It's been interesting to watch because, again, we've sat through a couple downturns at this point, COVID being the first one and this being the second one. During COVID, it was because it was such a knee-jerk reaction in the overall market. We actually spiked the yield very quickly. So things that were 9% immediately jumped to 12%. Things that were 12 jumped to 16%. That was the only way we were going to be able to close these transactions as investors were fleeing to safety, right, essentially. This time around, it's been more of a slow burn. And with the Fed's increasing rates, it's been sort of, I guess, slowly but surely taking the rates upwards and upwards. And so things that were 12% started to price at 13, things that were 13 started to price at 14. I think next month, 12 is going to be 14. So it's all kind of moving in that direction. And the spread against public debt, especially investment grade, is getting higher and higher as a result. But that's just the nature of, I think, the more frequent nature of us going out to market with these transactions. You have a much better sense of pricing just by virtue of the fact that these are just much shorter maturities.
If we look at the supply side of private debt, how has that reacted to the rising interest rate environment and the high yields?
What's been interesting is one of the asset classes within private debt is venture debt. And so with the likes of venture capitalists just kind of running for the hills at this point and not really deploying capital, every company that has taken VC money is looking for venture debt right now. So the moment we launched our venture debt offering to the market and saying, hey, we're ready for business, we got an influx, like hundreds of signups for companies looking for venture debt. And it makes sense, right? They all need to find a way to bridge the gap. They need to find a way to hit 18 to 24 months of runway in a point where they may not be able to get it themselves today, and the venture market is closed. So we've seen a lot of demand for that. On the kind of traditional supply side, I would say it's very much business as usual. There is some things that are shocks to the system. I think the supply chain issues are definitely impacting a lot of businesses, and it's causing them to want to go out to market more. But in this environment, some people are trying to hold on for dear life to the rates that they secured a while back and last as long as they can, because if they need to take and go out to market and get the higher rates today, it's a very different spread-based business, right? And so they need to find a way to turn profitable on that side, which is not the easiest in such a short order.
Oh, true. One of the things that I look at as a global investor in debt markets is obviously the risk-adjusted return. One thing is the nominal that you can earn, but you, of course, need to compare it to the volatility on the line, right?
Sure.
So take us through a bit your thinking on the volatility within the private debt sector compared to the public debt sector.
Yeah, I would say, the volatility is definitely there, but I think it also has a better reflection of market sentiment at the time, right? It actually changes and adjusts much more quickly. Just as an example, a lot of our durations of notes are sub 9 months, and they have call periods within a 1 month, 2 month period, right? So you're going to be able to see that yield change pretty much in real time, like we did during COVID, like we did recently, as we start to figure out what market demand is going to be. On top of that, we have a pretty interesting syndication system that allows investors to essentially bid across a range of different APYs for what's their minimum they're willing to take, right? That becomes the most interesting. So obviously the highest APY has the most demand. The lowest APY has the least demand. And you're starting to see, from a data standpoint, you're starting to see the investors are asking for higher and higher APYs. Like, it's as simple as that, right? They're not willing to take lower at this point. It's causing us to have to close at the higher end of the spectrum, which makes sense given the overall market conditions. This is definitely sort of where things are headed, and it's probably going to be where it's going to be for the foreseeable future. So volatility impacts private debt much more from a yield standpoint in reaction to how the market is doing at that point in time.
So if we look at risk-adjusted returns, say a Sharpe ratio, for example, where you compare the excess return on an asset to the underlying volatility in the asset, how would you find private debt compared to other asset classes in such a comparison?
I would say my personal opinion, I guess slightly biased, is that I think it does perform better than other asset classes. I think it's slightly more predictable. I think the yield and the spread above public debt specifically is worth the premium, right? That's just my opinion, because of the fact that it does react much more quickly, it does adapt much more quickly. You're going to be able to generally get higher returns on that side, as long as you deploy capital into the right opportunities. So there is definitely some selection and skill involved in that. But if you can do that properly, that's the reason why the Apollos, the Blackstones of the world have been deploying more now than ever. Basically, they've been growing their assets under management significantly in the private debt side in the last, call it, year or two, because they know that risk-adjusted return is great on this side relative to what they can get anywhere else.
We've seen how so-called duration assets have been absolutely hammered through the first couple of quarters of this year. Take the example of a 30-year bond with a coupon of 1%. When market rates start rallying, obviously you will get slaughtered basically from a mark-to-market perspective on such a long bond. What is the average duration in the private debt space? Is it much shorter?
It's definitely shorter. Yeah. I mean, even like the legal finals on some of these larger transactions are going to be in the 5 to 6 year mark, right? And they have turbos and amortization schedules that kick in within, call it, 1 to 2 years, basically. We've done multiple transactions like that. The largest transaction we've ever done was 144 million, and it has that type of attribute associated with it. Those are the larger it is, generally the longer dated it is, the smaller it is, the shorter dated it is. So the smaller sides of the transactions, like our $1 million, 2 million, 3 million transactions, those have sub 9-month maturities, and they have call periods built into it within 1 to 2 months, which kind of is what the investors are looking for. Somebody who's investing in that type of paper probably is generally just an accredited investor, and liquidity matters the most to them. And so they can actually get almost like inherent liquidity from the fact that they can choose whether to put into the next offering or take it out when the call period triggers.
If we look at the current macro environment, I think a lot of people agree currently that there is a high risk of a recession around the corner, if we are not already amidst one. How would you expect private debt to fare through an actual recession? I don't really consider the COVID recession to be an actual recession.
Yeah, I would say if '09 and '08 is any indication, it tends to do very well, right? Because there is significant demand from the borrowing base to want and secure loans to be able to continue to survive in that kind of downturn of an economy. And on top of that, I think the risk-adjusted returns, so what we just talked about, become more worth it because the spread and the yield is so high at that point. So private debt has proven itself multiple occasions already through a recession. And it's shown that's resiliency. It's also shown the ability to price things properly as a result. And a lot of things that we're doing on that side are designed to help things kind of price better, essentially, with more transparency and visibility into what the true underlying market demand is going to be. So if you have that, you can essentially get a more efficient, faster turnover public debt market, is what you're seeing in private debt, which becomes very, very interesting at that point.
One of the things that I'm on the watch for currently is the average default rate among companies. And I guess you basically have more or less live data on whether companies default to a larger extent than just 1, 2, 3 quarters ago. What is your current assessment of the default rate probability and the spillovers to the macro environment?
Yeah, I always like to compare COVID versus now because those are two such distinct different types of shocks to the system, right? So during COVID times, we saw obviously these businesses just straight up shuttered, right? There was like no business to be had. Everyone was stuck at home. And so there was no income coming in. But what was interesting to see was that the collection rate actually stayed pretty consistent, which means that the borrowers are not looking to default. They're actually looking to try and survive and just wait this whole thing out. The days past due of a lot of these loans was getting longer and longer and longer. So what was current became 3 to 10, became 10 to 30, became 30 to 60, right? So you start to see that for sure. But the fact that the collection rate stayed pretty constant gave us comfort that we could continue to operate in this space and provide capital to these lenders who are going to be providing the financing for these small businesses. This time around, we're seeing the collection rates start to dip a little bit, I think, relative to what it used to be even a couple months ago. But the days past due is not changing all that much. And so it's almost like the reverse happening at this point, which is pretty interesting to see. So I think it's in many instances, if a business can make it, it's going to make it. If it's not going to make it, it's not going to make it. And that's why the collection rate is starting to change. So it's definitely fascinating to watch. We have pretty much a front row seat to all of this, which has been really, really cool to see. And it allows us to really react as well when it comes to coming up with structures that would work in this new normal.
If you were a private investor, what would you consider sort of to be the pros and cons of buying private debt instead of public debt?
I think the pros is definitely going to be around the yield side, right? Like it is that's really the biggest advantage here. And the cons also is the yield, because if you're investing in something at that yield, there is definitely inherent risks within that. And the platforms out there, not including ours, who cannot provide that level of visibility and transparency, just means that you're kind of almost like investing and praying it comes back in some respects. And that's a little bit challenging for me as an investor to invest in, right? So doing the diligence is even more critical in private debt when there's just not as much information available out there. And sometimes it's intended to be that way intentionally, right? They don't want that transparency because then you'd probably never invest. So that is sort of the kicker around private debt that people just need to be aware of, that it's not, nearly as safe or as standardized as public debt is, and just know what you're walking into.
I also want to allow you the opportunity to talk maybe a decade ahead, because this is obviously a growing asset class, one that may be competing directly with banks in the future as well. What's your sort of prediction for the asset class when we look 1, 2, 3 decades ahead?
Yeah, I think it is going to continue to be on the upswing. I think banks have not shown any indication they want to come back into this space. What these private debt lenders are going to need to figure out, though, is that a low rate environment is probably gone for a while. And so that's going to wash out a lot of these lenders who just never had the ability to run a proper spread-based business. On top of that, I think because of the high rate environment, the VCs are going to start walking away from these lenders as well, right? And so now you're going back to the old school traditional way of doing things with with a lot more technology involved, better infrastructure from fintech companies to be able to do better underwriting per se. But you're going to see, I think, significant consolidation in the space. You're going to see less players because it's just less interesting, less possible to do these types of things. And it becomes almost like a land grab based on asset class, essentially. So it is fewer players, I would say more profitable, healthier businesses than what it is today. I think VC capital pouring into this space generally has meant that it's been a little bit looser on underwriting. And you can look at the likes of like what the buy now, pay later companies have done. It's been problematic, right? They started to see default rates tick up, but they were subsidized by VC capital. So they need to learn how to really do better underwriting on that side. And then with that, it's just going to be a healthier, larger market. And the hope is that, if we are successful as Percent, bringing a lot of these public market efficiencies into the space, what is today a $7 trillion market should easily become a $9, $10, $11 trillion market because you have the market standards, the data standards, and the network of participants there who can all transact with one another without having to rely on Excel, phone calls, and emails. It just makes things better.
Yeah. Currently, we are talking about private debt in a fiat currency space, right? Could you imagine a large portion of this market moving into crypto space over the next couple of decades?
Oh man, crypto. We've gotten a lot of requests from crypto firms to have us work with them in some way, shape, or form. And I think crypto has a lot of different shades, right? You have the DeFi side, you have the real world asset side, you have sort of the staking, I guess it's partly DeFi as well. But it's just a hodgepodge of everything. And I think what's been interesting to watch is that a lot of these companies are trying to learn and speed run through financial markets and financial market history that has taken like several hundreds of thousands of years to create. They're kind of just doing it in 2 months, 3 months time, and they're seeing the blowback as well coming from that. In the fact that regulation has helped finesse this industry for the better. Regulation's always slow, inevitably. They take a long time to figure out, but when they do figure out, they're generally right. And so financial markets have been honed and I think fixed in many regards so that people can't take advantage of the system. DeFi, for example, is regulations coming without a doubt, and just seeing the way some of these have blown up recently. And centralized finance, definitely, a lot of them are going to be regulated for sure. And in that space, then, when regulation happens, I think crypto becomes a viable option. But they still have that challenge here of how do you actually get a real world asset on chain to be able to run through an entire private debt transaction, like a securitization, for example, right? And that is not easy, and it also doesn't necessarily make a ton of sense. So if you'd have to literally get every single part of the supply chain or the consumer or their bank account, whatever it may be, to be on chain in order for nothing to break or in order for fraud to not actually happen in that transaction at any point in time. If you can't do that, then there's a break in the link, then something can go wrong. In which case, just do it the old-fashioned way, because if something goes wrong and somebody gets liquidated from a smart contract and there's no one to call, that's kind of a problem because it wasn't necessarily their fault. So, there are almost like gates up intentionally with inefficiencies to help protect the consumer or the underlying borrower that just is not there in DeFi, for better or worse. And I would argue sometimes that might be for the worse, because you need to be able to get on the phone with somebody and just hash things out together.
Yeah, we've been talking a lot about the investor side of private debt, but let's move the focus a bit to the other side of the equation. Let's assume that I'm a company owner wanting to try and dip my toes into the private debt market. How does the process look like if I wanted to do so?
It's actually very simple. You actually don't even realize as a company that you're engaging with private debt per se, right? Because when you go on to any of these loan comparison websites as a small business, you just Google, small business loan, right? And you'll have almost like the Kayak or the Expedia or Credit Karma of small business loans. You just see a bunch of different lenders out there that can give you that financing. What you don't realize is that the ones that aren't banks have that credit facility behind them to be able to offer you that loan. So you've already engaged the private debt market without realizing any different. There are some shades of lenders that are better at technology than others. So some may require you to link a bank account. Some may require you to upload certain documentation or just have it be analyzed by their system. All those things are things that are behind the scenes and infrastructure related, but they are definitely in the private debt space squarely. If they don't have a lending license, if they don't have a banking license, then they're probably a non-bank lender who is a private debt lender.
If we take a live look at the Percent webpage and the deals that are currently open, give us a brief overview of what you can actually invest in there right now.
Yeah, it's a little bit of everything. We have trade finance on one side, which just launched. We're about to go out with a venture debt deal that we're very excited about. It's our second one. The first one was ourselves. We raised venture debt for ourselves on our own platform just to test it out and see if there was demand in the market. There definitely was. We wanted 5. We ended up getting over 7 million, which is fantastic. And we love our investors for being able to do that for us. And then we also have small business lending. We have, I think, various different types of receivable financing. So it is a very, very wide mix. And we've seen investors appreciate that, right? We have investors there is one investor who invests $500 in every single deal, and they're still doing it. So we've had 330 plus transactions at this point. The guy's very diligent. We appreciate him very much. There's also investors who invest only in the US. There's investors who invest only in Latin America. So we give them that optionality. And there's deals that come out pretty much every week at this point, multiple at a time for people to get exposure into. And it's a very seamless, easy process to just, a couple clicks, you've made that investment, and you'll start to see the returns come back in a month's time.
And what are the current yield levels that you can expect to find on the page?
So things that we're widening the band, let's put it that way. Yeah. So there were times where we were able to kind of keep it pretty tight between, call it 9 and 10, 10 and 11, something like that. Now we're going out like 12 to 15, essentially, just to see what it takes to be able to close. The good news is, and it depends on the borrower, right? So these investors are savvy. They're making the right call based on what they see in the surveillance reports. There are times we've gone out with 12 to 15 and it closes at 13.5, right? So it actually is on the lower end of the spectrum, which is great for the borrower. There's other ones that are 12 to 15 and closing definitely at 15, and that's out of necessity. And so it's just, we're seeing this market play out in real time with real time market pricing, which you just really don't get anywhere else.
You write on the page that the product is basically designed to be diversified. Can you please take us through what you mean by that?
Yeah, I think offering as many asset classes as we do, as offering as many duration ranges as we do, and offering as many minimums that we do, just gives the ability for the investor to kind of do whatever as they please, right? So you could be that $500 investor who invests in every deal. By all means, go for it. That is the ultimate in diversification. You could be the ones who only like US and you double down on that, and you only invest in a couple at a time. You could be the ones who tried it out first, put $500 to work, since that's the minimum on a lot of our deals. A month later, you get paid, a couple dollars worth of interest. Tried to withdraw it. Cool, that worked. Let me put in $5,000. Okay, that came back a month later. I'm ready to really kind of just set it and forget it. And they invest in our blended notes, right? That basket of products to be able to get diversified exposure without having to click every single week or every single month into the next deal. So it is that optionality that we give to investors, and that's the best that we can do, right? Because we don't know exactly what this specific investor is looking for. We can just give them choices and options to be able to manage it as they see fit for their own objectives.
One of the ways to diversify a portfolio is via geography. How big of a spread do you have geographically on the deals?
Yeah, we have a big focus in Latin America, if only for the fact that we've seen a lot of VCs start to, not even start to, they've been focused on LATAM for a while. And so there is still, I would say, a arbitrage opportunity slightly, although that is narrowing very quickly in terms of the yield that you can get in LATAM versus in the United States. We have done only one deal in Africa at the moment. We are looking at it more. And Europe is just, table stakes, right? It's like very easy for us to be able to do in Europe as well as in Canada and the United States. So we do like our focus on Latin America quite a bit. And I think investors have appreciated that as well. It's been the yields we thought would be coming in a little bit lower on that side have actually started to come true on that side, which is great, right? It means that investors are starting to realize that, for a population that is underbanked traditionally, but fully on their mobile phones and pay everything through there means they have a pretty good credit history on that side. It actually is sometimes better and easier to underwrite there than it is in the United States, because some people still cut checks, in which case, that tells you a sign of how we operate as a banking system here in the US versus a fully digital, fully trackable, and fully underwritable system in Latin America.
When you look at the various geographies that you've done deals within, would you say that you can find differences in the outlook for private debt across those regions?
Yeah, absolutely. I think the US is a mature market, right? So you're going to just see a level of sophistication, I think, from a lot of these borrowers who just have been in the space for decades. And most of these, countries that are emerging markets have not had decades of financial innovation by any stretch of the imagination. They've had maybe a decade or maybe 2 decades of it. So that in of itself makes for a very interesting proposition on that side. But we are seeing that I think the pace of innovation happening in emerging markets is definitely faster than in the US. And that makes for a very interesting opportunity, especially since there's almost like less banks in these emerging markets as well, that you're going to see more a proliferation of non-bank lenders and private debt lenders come out in those places. And they're going to come out ahead of the banks as well. They've done very, very well, which is really exciting to see.
If we assume, Nelson, that we've had a regime shift in terms of inflation, in terms of interest rates, etc., where could you imagine spreads going, say, 1-2 decades ahead, if we really have a regime shift when it comes to inflation? Where would private debt trade in such a scenario?
It's a great question. It obviously depends on the asset class, the asset specifically, or sub-asset class. It depends on the borrower's performance naturally. But I would say if we're in a high rate environment, we're going to be pushing, I would say 16 to 20% easily on some of these transactions. And that's going to be sort of back to the way it was in some respects, right? I do think that there is a point. We're not going to be in a high rate environment forever. Like there will definitely be a point where it tapers. Just to be able to spur additional growth, just naturally, it's going to happen. But as of right now, for the foreseeable future, we're kind of coaching all of these borrowers that you need to get better and understand that this is going to be the new normal, and you need to be able to adapt accordingly. Otherwise, it's not going to end very well. This is your business at the end of the day. So you are completely tied to spreads, and you got to be smarter on that side.
I personally don't buy into this regime shift story, so at least you will get some tailwind from that front as a private debt supplier. But finally, I wanted to say that it's also important to discuss inflation versus the nominal yield in various assets during an inflationary period as the current one. And this is one of the asset classes with a positive spread to inflation still.
Yeah, and it will continue to be the case, right? And what's interesting is a lot of these institutional asset allocators are putting floating rates now in these term sheets. They're not going to deal with this fixed rate environment anymore because they can't predict it at the end of the day. So the opportunity for that means that these investors will obviously come out ahead, but it ensures that it always stays above inflation. And so between the risk premium you're paying for it and also just being able to attach a floating rate to it, it means that it will always be pricing above inflation at that point, realistically.
And this might make this a good product in an inflationary period.
I'd like to think so. I'm super biased, having been playing directly in this space. But we've seen, just looking at our own performance, inflation pushing the rate that it is right now. Our stuff and our products are still outpacing inflation at this point, right? Especially even in the diversified products where you can just set it and forget it. It's not a bad return in this environment where everything else is definitely veered towards a negative at this point, either on an actual basis or on a spread against inflation basis.
Yeah, let's see whether inflation comes down or not. Yeah. It will be interesting to follow that over the next couple of quarters. Nelson, thank you so much for giving us your insights into the private debt market. It's been a pleasure to host you. And I will tell to the audience that please visit the Percent website. It is an interesting product, also seen from my side in the space of the public debt sector. Nelson, thank you for joining.
Thank you so much for having me. It was great chatting with you today.
Likewise, Nelson. I'm Andreas Steno, and this was a Real Vision Essential interview. We will be back with more soon. Thank you.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.